Hey, welcome back. It's Nolan Mathias from Mortgage 360, and today we're discussing the fact that 5-year fixed rates are on the rise because bond market yields are on the rise. And we're going to discuss why that's happening and what it means to you and what your borrowing strategy should be going forward. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their mortgage or rent payment for a month just for subscribing to this channel. So go ahead, hit that subscribe button. It's free and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss why interest rates are going up, why fixed rates are going up. And let's be clear right from the get-go that it is fixed rates that are going to go up in the next couple of weeks, maybe the next couple of days, not variable rates. And the reason why is because bond yields are increasing. We still aren't seeing any potential increases to variable rate mortgages or the prime rate. We'll talk a little bit about why later on. But for now, what you need to know is that 5-year fixed rates are on the rise and what that means to you as a borrower. So let's get into it. Let's jump into the news because I want to show you exactly what I'm talking about here. The top stories on Google right now, especially when you Google things like bond yields, are things like the S&P ends lower as US bond yields rise. Tech stocks drag because of bond yields. Rising US bond yields pose new threat to sky-high stocks. Asia shares edge up as bond yields and resources steal the show. So the news for the last basically 4 or 5 days has been that bond yields are rising. And the reason why they are rising is that there's expectation, or at least speculation, that the Fed is going to stop their quantitative easing measures and stop buying bonds on the open market. And the reason for this is because there's this renewed optimism in the US that the coronavirus is nearing the end. Vaccines and the rollout is going to essentially allow the economy to recover, and in a lot of cases a lot quicker than expected. And at the same time, there's also an inflationary expectation that goes along with that conversation, which is why we are seeing these bond yield markets rise, is because the big institutional investors are seeing that they need to remodel their portfolios for the eventual inflation that may come, and as a result they are selling their bonds, which causes the yields to go up and ultimately affects your 5-year fixed mortgage. And this sort of rejigging of the bond market isn't uncommon. In fact, it last happened back in 2013, where as things got better in the US and the expectations became that the Fed was going to start increasing interest rates, well, with the expectation that things were going to get better in the economy, basically bond yields started to increase as investors left the bond markets and started investing in other things like commodities and the stock market. So basically, when you look back at 2013, you see this jump between May of 2013 and September of 2019, where bond market yields increased. If you look at that 5-year government bond yield, it basically went from 1.26% to 2.18% in a matter of 4 or 5 months. And what that meant for mortgages was that mortgage rates increased in proportion to what the bond yields increased. Now, the thing to note here in 2013 is that even though 5-year fixed rates increased, people who had a variable rate mortgage still did okay, because this is going back, looking at 2013, this is prime rate. And as you can see, prime rate pretty much remained the same. And then what you can see here is that as prime rate, which is the bottom blue line, continues to stay flat, you see the 5-year conventional mortgage rate go from 5.14 up to about 5.34. So that was that blip, that increase in bond market rates that we saw back in 2013. But even as the bond market rate started to come down, and what you can see is the 5-year fixed rate would have also come down at that time, people who had a variable rate had that same prime rate and therefore ended up having the exact same interest rate through all of this repositioning of the bond market. So if you are somebody who is in a variable rate mortgage right now, you don't really have to worry about your variable rate mortgage increasing right now, because there's a very good chance that interest rates are going to stay low for a very, very, very long period of time. In fact, the Bank of Canada has told us that they don't expect interest rates to start increasing until 2023. Now, if things went really, really well and inflation started to take hold and the economy started to grow again, could we see the Bank of Canada increase rates prior to that? Well, the answer to that is yes. However, there's a lot of things that need to happen prior to the Bank of Canada increasing the key lending rate, because what they need to do is they need to taper off their quantitative easing. They need to stop buying bonds from the government of Canada. They need to stop injecting money into the market before they start even thinking about increasing interest rates, which means we're probably still a very, very long time out before we're going to see those interest rates rise. And 2023 still looks like that is the time frame, at least as of this recording. Because what needs to happen happen before we start to see interest rates increase is we need to see a fairly substantial amount of inflation for a fairly long period of time. And if you go ahead and you take a look at the Bank of Canada's key inflation indicators, or the target rate, basically look at this gray band. And that gray band is where the Bank of Canada wants inflation to be. And until such time as you start to see inflation rise above that band, so until we get above 3% inflation, the likelihood of seeing an interest rate increase is very low. And as of right now, we're down here, we're just getting back to that lower band of inflation. The blue line is the inflation rate as of January 2021, and you can see it is just creeping up to 1%. And what the Bank of Canada is going to want to see is they're going to want to see that blue line get up above near the top of this gray band before they start increasing interest rates. So we've got this fairly sound strategy in the fact that if we take a variable rate for the next 1 or 2 years, we're going to continue to have a low interest rate. And what we're likely going to see is, just like back in 2013, we're going to see government bond yields and bond yields on the open market increase, and then probably come back down and correct themselves as the institutional investors rebalance their portfolios. So we've got this long period, this long runway ahead of us of low interest rates. And what we need to be considering is that just because interest rates go up 15, 20 basis points doesn't necessarily mean that we should be jumping on the fixed interest rate bandwagon. Now, if we start to see bond market yields go up and we see inflation at that 3 or 4% range, yeah, we should absolutely be looking at locking in our variable rate mortgages, or at least trying to get a lower rate short-term fixed mortgage. But until such time as we see that inflation number really high and bond market yields increasing, then we probably want to stick to that variable rate strategy. And that variable rate strategy is one that I've talked about in other videos before. All we're trying to do is extend the amount of time that we have low interest rates for, and that's by taking advantage of the next 1 to 2 years where we absolutely know that rates are going to continue to be low, and then start looking at locking in as interest rates start to go up. So the key thing here is, yes, fixed rate mortgages, the pricing on them is starting to go up right now. However, it's going back to a normalized rate above and beyond what a variable rate should be. There should be about 50 basis points or 0.5% difference between variable rates and fixed rates. That's about where we're headed to at the end of the week here. But that doesn't change our strategy going forward. If you're absolutely a fixed rate borrower, yes, then it means you want to make sure that you're dealing with a broker or a bank that has a rate hold in place for you. But if you are a borrower who wants to extend your amount of time at a low interest rate, take a variable for the next year or two, and then start looking to lock in as the variable rates and the key lending rates start to increase, not as we see small blips in the bond market yields because big institutional investors are rebalancing their portfolios. So if you found this video useful, do me that favor, hit that subscribe button and hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky winner, maybe it'll be you, will end up getting their rent or mortgage paid for a month. Cheers, we'll see you on the next video.